In 1923, a German teacher earned 300,000 marks per month. It was not enough to buy bread. 1 year earlier, that same salary would have seemed generous. 2 years earlier, it would have been wealthy. The Weimar hyperinflation did not happen because Germans were reckless. It happened because governments had a choice: admit financial failure or print money and pretend the problem would solve itself. Germany chose printing. Within 18 months, the currency lost 99.9% of its value. Pensions evaporated. Life savings became worthless. But the collapse did not happen suddenly. It happened in stages. Each stage looked different from the last. Each stage felt manageable until it suddenly was not. The pattern that destroyed Germany is not ancient history. The same mechanism is active today, and this time the stakes are global. The Weimar Republic inherited catastrophe from World War I. Germany's war debt was astronomical. Industrial capacity was damaged. Reparations demanded by the Treaty of Versailles in 1919 totaled 132 billion gold marks, roughly equivalent to 3 years of national income. Repayment was theoretically possible, but politically suicidal. No government could ask citizens to sacrifice for decades to pay former enemies, so the Weimar government made a choice that would destroy the currency. Instead of raising taxes or cutting spending, it borrowed from the central bank. The Reichsbank printed money to finance government deficits. Initially, this seemed to work. In 1920, unemployment fell. Industrial production rose. The economy appeared to be recovering. But the expansion was not real. It was monetary illusion. New currency chased the same goods. Here is the mechanism. As currency loses value, the government receives less revenue in real terms. To maintain spending, the government must print more currency. More printing causes faster inflation. Inflation reduces tax revenue further. The government must print even more. The cycle accelerates exponentially. By early 1923, the inflation was visible and undeniable. The mark traded at 18,000 per dollar in January. By July, it was at 350,000 per dollar. Ordinary Germans watched their purchasing power collapse in real time. Savings accumulated over decades became worthless in weeks. The Reichsbank governor, Rudolf Havenstein, believed the printing was necessary to maintain production and employment. He was wrong. The currency was dying, and each new round of printing was poison, not medicine. By August 1923, the mark was trading at 4.6 million per dollar. The government had entered what economists call the fiscal dominance trap. When government debt becomes too large relative to tax revenue, the only apparent solution is to inflate the debt away. But inflation destroys the currency that denominated the debt. By September 1923, the mark traded at 98 million per dollar. The collapse was no longer a financial problem. It was a social emergency. The collapse unfolded in stages, and each stage revealed different consequences. Stage 1 was the denial phase, from 1920 to 1922. Inflation was acknowledged but minimized. Prices rose, but wages eventually followed. Asset owners saw the value of real estate and equities hold relatively steady because nominal prices rose with inflation. Those who borrowed money benefited because they could repay loans in worthless currency. Banks and large corporations with access to new credit could refinance constantly. Here is what most people miss about this phase. The government believed it was temporary. Officials thought that once reparations were restructured or resolved, the currency would stabilize. This belief justified continued accommodation. Keep printing just a little longer. By 1922, those close to credit and asset markets had begun repositioning. Business owners borrowed heavily and converted currency into inventory, equipment, and real estate. Those with access to foreign currency held marks for wages and debts, but conducted actual business in foreign currency. A German engineer named Karl documented this period. His salary in 1921 was 20,000 marks monthly, sufficient for a middle-class life. By 1922, he noticed prices rising faster than his raises. He converted a portion of his savings into a small apartment. This decision saved him. Stage 2 was the acceleration phase, from 1922 to 1923. Inflation transitioned from rapid to visible catastrophe. The mark dropped from 400 to 1 million against the dollar in just 6 months. Denial became impossible. Ordinary Germans began spending marks immediately upon receiving wages because by the time they returned home, the currency had lost value. Barter systems began replacing monetary exchange. Some communities created local currencies backed by labor or goods. This is where doctors drove taxis, teachers cleaned houses, and engineers washed cars. Not because there were no jobs, but because mark-denominated wages had become worthless so quickly that employment itself became pointless. A doctor accepting goods or foreign currency made economic sense. The government's response was to print even larger denominations. 1 trillion mark notes appeared, then 10 trillion, then 1 quadrillion. The notes became jokes. Children used them as wallpaper. Currency represents more than purchasing power. It represents faith in the system itself. Even during Stage 2, those positioned correctly survived. Farmers holding grain and livestock bartered successfully. Those with foreign currency maintained purchasing power. Those who owned land, equipment, or productive assets could still exchange them for food or labor. A Berlin businessman named Ernst had imported goods paid for in marks years earlier. In 1922, he saw what was coming. He converted his mark inventory into a small industrial equipment business. By 1923, as currency collapsed, businesses desperately needed equipment to restart production. Ernst's inventory was valuable. He survived. Stage 3 was the terminal phase, from August to November 1923. By August, the mark was worth so little that calculation itself became impossible. The Reichsbank printed continuously. The presses literally could not keep up with demand. On November 20th, 1923, $1 equaled 4.2 trillion marks. On November 21st, $1 equaled 2.5 quadrillion marks. The currency had stopped functioning as money. This is where ordinary people faced true ruin. Pensions became worthless. Insurance policies became worthless. Bank deposits became worthless. The government had effectively confiscated the savings of the entire middle class through inflation. A widow named Margaret had saved 50,000 marks from her husband's insurance proceeds in 1919, equivalent to roughly 2 years of a middle-class salary. She intended it to sustain her through old age. In November 1923, it bought maybe 3 days of bread. Her life savings were gone. She was 67 years old. She had no means of recovery. But 1 block away, a property owner named Heinrich, who had borrowed 40,000 marks in 1920 to buy an apartment building, discovered that his debt had become trivial. He repaid it with currency barely worth the effort to collect. He owed his creditors wealth. The creditors received worthless paper. Stage 4 was the transition. On November 20th, 1923, the German government stopped printing marks and introduced the Rentenmark, a new currency backed by mortgage bonds rather than gold. It was a psychological reset. The hyperinflation ended not through policy success, but through monetary regime collapse and replacement. The mark was dead. Something new had to begin. The entire monetary system that had functioned for centuries had been destroyed in less than 4 years. The velocity was what separated Weimar from other inflations. Weimar compressed decades of damage into months. What actually survived the Weimar collapse? The answer reveals a pattern that appears in every currency failure. First, land and real productive assets. The value of farmland, apartment buildings, factories, and equipment remained relatively stable in real terms. Farmers could plant grain, factories could make goods, buildings could shelter people. These things had intrinsic value independent of currency. Second, foreign currency. Those who held dollars, pounds, or francs, or even just claims on them, preserved purchasing power exactly. The Weimar collapse was internal to Germany. External currencies were unaffected. Third, goods and inventory. A manufacturer with warehouses full of goods could exchange them for whatever currency or barter goods remained valuable. A textile merchant with fabric, thread, and finished goods could trade them for food, labor, and materials. Fourth, skills and knowledge. Doctors, engineers, and skilled tradespeople maintained their ability to produce value. Karl the engineer's knowledge did not inflate away. As the economy began recovering, his skills were even more valuable because production needed to restart. Fifth, gold and silver. Though not widely held by ordinary Germans, those with small amounts of actual metal held value. 1 ounce of gold bought roughly the same quantity of goods in 1920 and 1923. What did not survive? Bank deposits evaporated. Bonds and notes denominated in marks became worthless. Pensions paid in marks became worthless. Cash savings in marks became worthless. Government securities became worthless. The entire apparatus of financial saving within the mark system failed completely. The pattern is unmistakable. Those who preserved wealth understood one core principle: currency is contingent. It only has value as long as the system supporting it functions. When the system fails, currency fails. Those who positioned defensively before the system failed survived. Those who believed the system would recover until the collapse was undeniable did not. The transfer of wealth from savers to those with assets happens before the collapse becomes obvious. The Reichsbank director Havenstein died in November 1923, just days before the new currency was introduced. He had been printing money continuously, defending his actions as necessary to maintain employment. He died believing he was fighting for the people. In reality, his printing had transferred massive wealth from savers to borrowers and asset owners. Fast forward to today. The mechanism that destroyed Weimar is not merely historical, it is active in multiple modern economies. Several countries are currently running large government deficits financed partially through central bank accommodation. The exact same mechanism. Argentina entered hyperinflation in 2019 to 2023. Venezuela has been in persistent inflation for a decade. Turkey experienced 64% annual inflation in 2023. Lebanon's pound lost 90% of its value between 2019 and 2023. Sri Lanka experienced 60% inflation in 2022. The pattern is not rare, it is recurring. The warning signs are unmistakable: higher inflation targets, persistent fiscal deficits, central banks purchasing government debt directly, currency losing value against hard assets or foreign currencies, and savings rates shifting as people reduce local currency holdings. Here is what modern governments have learned from Weimar. Communicate the inflation as temporary. Describe it as supply-side rather than monetary. Blame external factors, war, pandemic, supply chains, rather than policy. This narrative works until it stops working. The practical implication is straightforward. Those who reposition early, who shift a portion of wealth into real assets, productive businesses, land or hard currencies before the collapse becomes obvious, preserve wealth. Those who wait for official confirmation reposition too late. The skill that matters is pattern recognition. Weimar's timeline was compressed. Modern inflations may develop more slowly, but the stages remain consistent: denial, acceleration, catastrophe, replacement. Each stage looks different in real time than it does in hindsight. The core pattern is simple. Currency collapse does not happen to economies. It happens because of choices made by governments unable or unwilling to constrain spending. The collapse redistributes wealth from savers to those with assets and those close to new credit. Understanding this pattern is not about predicting exact timelines. It is about recognizing which stage the system is in and positioning defensively before the next stage arrives. Those who understood the Weimar pattern early could reposition. Those who believed official reassurances were destroyed. History has lessons. This is one of them. The question is not whether modern governments face similar pressures. They do. The question is how you position when the pattern becomes visible. Next week, this channel will examine how ordinary people actually positioned during the Argentine collapse, the strategies that worked, the decisions that failed. If understanding how systems fail before they collapse interests you, subscribe. History has the answers. The question is whether you can see the pattern before the collapse becomes obvious.